Welcome back, students who are taking financial accounting, and in this series of videos we are working on the short exercises that were assigned in the digital study guide for chapter 9. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so we're going to be working on the short exercises here, and we are starting with 9-2. And it says here, accounting for notes payable. So on April 30th, 2014, Dawson Company borrowed $6,000 on a 1-year 9% note payable. Okay, so he's borrowing $6,000, 1 year, 9% note payable. And that was on April 30th. So what would Dawson report for the note payable and the related interest payable on its balance sheet at July 31st and on the income statement for the year ended July 31st? Okay, so first off, kind of what I would do is I would draw a timeline here. Okay, so let me do that a little bit better. So I'm going to have a tendency to draw a timeline here in order to get my bearing on things. Okay, so this is April 30th, and it's asking me what's on the balance sheet and the income statement at 7/31. All right, so this is the end of April, this is May, this is June, this is July, so this is like 30, the end of May. All right, so May has 31 days and June has 30. So this is May 31st and this is June. So this here is a 3-month period, even though it's a 1-year note, okay, at 9%. So it's asking, the question is asking, what amounts would Dawson report for the note payable and the related interest payable on the balance sheet at July 31st. Okay, so when we make the original entry for the note, okay, remember the entry would be something along the lines of a debit to cash for the 6,000 and a credit to the note payable for the 6,000. So that's what the entry would be making on April 30th. So when it gets to July, all right, we're still going to see the note payable as 6,000 because we don't have to pay it off until 1 year later. Okay, we don't have to pay it off until March 31st of 2015. That's 1 year later. So on the balance sheet, that note payable of $6,000 is going to be in the liability section. However, the interest, we have to accrue the interest. All right. Now, we're not paying the interest, but we have to match up our revenues with our expenses. And so therefore, when we took in the $6,000, we're going to have an interest expense for that 3-month time period. Well, our entry is going to be, a debit to the interest expense, but we're not going to pay out the interest just yet. Okay, so that's going to be a credit to interest payable, right? Because we don't have to pay the interest either until 1 year later. So in calculating the interest, we have 6,000 at 9%. Let me do the math. So 6,000 times 9% is $540, right? And that's for 3 months over 12. So times 3 divided by 12 gives me $135. So our interest payable is going to be $135 on our balance sheet. Okay, so our note payable is going to be 6,000. Our interest payable is going to be 135. And it also says here, and on its income statement for the year end, what amounts would Dawson report for the note payable and the related interest payable on the balance sheet? That's that 135, and on its income statement. So on the income statement, we're because of this entry, it's going to be a debit to the interest expense for 135, and a credit to account interest payable for 135. So on the income statement, we're going to show the 135 there also. Okay, so that's it for this particular exercise. If you don't follow, if you don't understand something, watch the video again. And if you still don't get it, feel free to contact an instructor. But let's move on to 9-3 here and get this one in this video. All right, so it says here, Sunday's Boats guarantees its boats for 3 years or 1,500 hours, whichever comes first. All right, so that's a guarantee, right? Past experience indicates that Sundays can expect warranty costs will equal 4% of sales, right? So it's 4% of sales. That's going, so we're going to do, we're going to use that 4% for our estimated warranty. Assume in the first year Sunday's boats had $607,000, had sales totaling $607,000, receiving cash for 35% of sales and notes receivable for the remainder. Warranty payments totaled $18,500 during the year. Okay, so 1, record the sales, warranty expense, and warranty payments for Sunday's boats. Ignore cost of goods sold. Right. So to record the sales, all right, we had $607,000 in sales. All right, so write this down, because when I complete these entries, I am going to erase them. All right, because I only have this space down here. So if I'm going to record the sales, I have a credit to sales revenue for $607,000. Okay. Now we received 35% of sales in cash. So 607,000 times 35% gives me $212,450. So that's a debit to cash for $212,450. And then of course we have a debit to our notes receivable, right? Because it says receiving cash for 35% of sales and notes receivable for the remainder. So the difference between those two numbers is $394,550. Okay, so that's the journal entry for number 1. So if you have to, pause the video and write that down, because I'm erasing it now. Okay, so that's the first entry. All right. Now we have to record, so we did this, record the sales. Now we're going to record the warranty expense. Okay. And the warranty costs 4% of sales. So if I have 607,000 at 4%, that gives me $24,280. Okay, so my warranty expense is the 24,280, and we offset that with our estimated, because that's what we estimated our warranty to be. And I'm just going to put WAR for warranty and make that, or actually, let me just start using this nomenclature. Warranty payable, okay, for $24,280. So that's how we are going to record our warranty expense, right? Remember, warranty payable, estimating these warranty is very similar to allowance for doubtful accounts or allowance for uncollectible accounts, where you make an estimate and you put that amount in that payable account, and then you offset it by whatever it is that you end up paying out, okay? Or in the case of uncollectible accounts, whatever you decide that you're going to write off. Same exact principle. You calculate the estimate and you put it to the payable, right? So pause the video if you have to, write that down. Okay, so now I am going to do the warranty payments. Okay, it says so. Warranty payments totaled $18,500 during the year. Okay, so in that last entry, we had warranty expense for the $24,280, right? And then we had our estimated warranty payable for $24,280. Now that's a credit, right? Okay. So when we actually have payments that go against it, we have to offset that, right? So our entry is going to be a debit to the estimated warranty payable in the amount of $18,500. Okay, and we're paying out the cash. We're crediting our cash for the $18,500. Okay. Yeah, just something that caused me to think about this just for a second. I mean, if you were going to, let's say, for example, you didn't see that entry, okay, and now you're going to make this journal entry, okay? So how are you going to make the journal entry? Remember, go back to the thought process on how to make journal entries. Warranty payments totaling $18,500. So my first question is, am I affecting cash? And my answer to that is yes, I'm affecting cash because I'm paying out $18,500. All right. So I would credit my cash, all right, $18,500, and then of course debits have to equal credit. So what am I going to debit? Well, the only thing that what am I doing with this? Well, it's a warranty, okay? Is it an asset? No, it's not something I own. Is it a liability? Yes, it's something I owe, or I'm estimating that I owe, all right, for warranties. It's not equity, obviously. It's certainly not revenues. Could it be an expense? Well, yes, it could be an expense, except we already booked the expense for 4%. Okay, so it's not an expense, so it has to be the liability. And if you look through your liability accounts, you'll see the estimated warranty payable account, and you've just made your journal entry. Okay, so go ahead and pause the video. I'm going to erase that and go on to part number 2. Okay, so number 2 here says, post relevant portions of the journal entries to the estimated warranty payable T account. So let me create a T account here. Call it estimated warranty payable. Remember, the T account only represents T accounts are a tool. Okay, you can use it for a variety of reasons. In this case here, we're using it to just look at the one general ledger account to see what's in that general ledger account. At the end of the first year, how much in estimated warranty payable does Sundays owes to its customers? right? So if you remember when we booked the warranty expense, which was 4%, we had a credit to that account for 24,280, right? Now we're going to make the payments, all right? So in that entry for the warranty payments of 18,500, right? We had a debit of 18,500, okay? So our balance in the account ends up being a credit of $5,870, okay? All right, so go ahead and pause the video. I'm erasing. And now for 3, what amount of warranty expense will Sunday's report during its first year of operations? Right. Does the warranty expense for the year equal the year's cash payments for warranties? Right. Which accounting principle addresses the situation? Okay, so what amount of warranty expense will Sunday's report during its first year of operations? Well, that's that entry we made for the warranty expense, which was the $24,280, okay? Because we debited the warranty expense and credited the estimated warranty payable. That was our second journal entry. So that's the amount. Now, does the warranty expense for the year equal the year's cash payments for warranties? No, because we're paying the cash payments are only 18,500. We're booking the warranty expense of 24,280, and that difference of 5,780 still sits in that warranty payable account, right? Which accounting principle addresses this situation? And this is all predicated upon the matching principle. This is, one of the most used principles from generally accepted accounting principles, right? GAAP, right? Is the matching principles, where we have to match, which states we match up our revenues with our expenses, during the accounting period. So, we're getting revenue because we're selling this stuff, but we have to be able to book any expenses that might occur. And if I'm making a sale on 1/1, and let's just say 2016, right? And let's say that warranty period covers 3 years, which is 2019. That's a 3-year period. Okay. Sometime in 2019, if you had an expense, now remember, we're booking revenue here, okay? And we're always making these sales, but the expense only comes in one big hit. This is the way I think about it. One big hit when you have this big warranty expense. Well, that, it mismatches your revenues with your expenses, okay? So you try to book your warranty expenses, okay, when right up front, when you match it with the sales that you're going to make, based upon what is estimated is going to cost you to pay off those warranties, those repair bills. So if I have, say, like in this case here, I have $607,000 of revenue. Well, based upon that sale, I'm expecting that I'm going to have $24,280 in expenses, to go against that revenue. So I have to match it up in that accounting period. And that's why I'm making that journal entry for the estimated warranty expense. Now, granted, I'm not going to use that, that repair might not come in until the year 2019. All right. But I've matched the revenue with the expense in that particular accounting period, and that's why we end up using the warranty payable. It's a payable, it's a liability, right? It's something that we owe down the road, so that when we actually have to use the when that bill comes in, then we're going to affect our cash, which is what we're doing with erase some of this here, which is what we're doing with this here warranty payment. That's when our cash goes out, and we offset it against the estimated warranty payable, because that's a liability. Okay, it doesn't affect our revenues or our expenses in the year 2019. Okay, when we actually pay that out, we matched up the revenues with the expenses in the year 2016, and that's why we're doing, we're making this estimation. It's the same exact thinking, like I said, for bad debt. Okay, the book, the solution says no, the warranty expense for the year does not necessarily equal the year's cash payment for warranties. The matching principle addresses this situation. Cash payments for warranties do not determine the amount of the warranty expense for that year. Instead, the warranty expense is estimated and matched against revenue during the period of sale, regardless of when the company pays for the warranty claims. So that's, the big thing there is the warranty expense is estimated and matched against revenue during the period of the sale, regardless of when the company pays for the warranty claims. So basically that was one sentence that kind of like said everything that I just got done saying and scribbled all over the screen. Okay, so with that, we're done with this particular exercise, and we'll move on to the next one, 9-4 in the next video. All right, if you don't understand something, watch the video again. All right, and if you still don't get it, feel free to contact an instructor.